Hi, I'm Jonathan Gurney, Portfolio Manager at Gurney Financial. The purpose of these videos is to educate and keep clients aware of what we are seeing on a daily basis in the stock market. Our goal is to close the gap in communication between clients and the actual person managing their assets. We use fundamentals primarily and technicals as part of our analysis. We hope the charts and education help clients and viewers alike. A friendly reminder that this video is not to be taken as financial advice. Should you have questions, feel free to reach out to us through email, social media comment section, and please subscribe to our YouTube channel. When new stuff comes out, you'll be notified. We'll also be updating our website shortly, and this will all be on there. So be patient with us, and we'll get that out to you. As many of you know, the goal and purpose of this is really to keep you apprised to what we are thinking. If we are concerned, we will tell you and trade accordingly. If we're kind of in a rut, which honestly I think we are in, these are summer months. This is typical trading movements that we are seeing during these months. So keep that in mind. We want to be real in saying we will probably range in the 2,800 on the S&P 500. Again, 2,800 to 2,950 level. Midterm, we do think the move is higher. I think we are very close to establishing a base, but you'll see through the stuff that we're about to show you, we could go a little bit lower here, but hang in there. It's basically a 2 to 3% move that we're saying we could test. But midterm, the backdrop is very good. Central banks globally are cutting rates, including the United States. That is not a bad thing for equities. Keep that in mind. So again, short term, it could be nuts. Midterm, I don't want to sell here because we're working on a base. You're starting to see risk on start to get a little more interest here. We'll see if it continues. We'll show you charts that show that. Again, two main things that we believe dictate the market. Interest rates and earnings. Earnings are okay. Interest rates are a good environment for equities. So those are the two primary areas that we're paying attention to, and we do not want to be sellers during this period. So let's get into the chart. And again, we want to reiterate this. We do not view this as a recession. We do not see a recession in the near future. Could the stock market go down another 10%? Yes. It went down 20% in October to December. Was that a recession? No. These are kind of normal movements. Again, we on average see 3-5% moves a year. That's normal. These are normal movements. If we see extreme movements, we will change our perspective. But tariffs are kind of the primary thing we got to pay attention to. So let's get to the charts and we will proceed from there. All right, as we said, the S&P 500, 2,950 to 2,900 level is kind of an area we have continuously struggled to get out of. Eventually, I do believe we will get out of that, but we will probably trade in the 2,950 to 2,800 range for a couple more weeks. So be patient. If you can't handle the volatility, don't watch your account. It's probably best for some that they don't. It doesn't, if you're used to it and can mentally say, wow, that was an interesting day, and not have you thinking the world is ending, then that's okay. You can watch your account. But if you are watching the news and they are talking you into a recession, don't play that game. You will lose your mind. So one thing we do want to see is the RSI level go above 50. When we're above 50, we tend to, for a couple months, be in a good period. Again, above 50, tested a little bit below here, but overall good periods here. We want to get back above 50 pretty quick here, and that would be ideal. Next chart, I believe, is the QQQ, which is basically similar to the Nasdaq, more tech-based. Kind of an interesting chart here. This is where we're saying keep an open mind on the market. If we test a little bit lower here, this is just being real with you. Advisors will not tell their clients here. They will say, you'll be fine. And long term, totally agree that long term, the movement is almost always up, period. But short term, we're in a little bit of a rut here, just being real with you. We will probably get out of it in a couple weeks. So hang in there. What we're showing here is a double tap at the RSI level of 30. Double tapped. We have not double tapped yet. Could it go back here and go back up? Potentially. That's what happened in May of 2019 recently. Double tapped and then finally went higher. You're seeing a bottom here, right here, and moved higher. What we're seeing here, key levels to watch on the QQQ are the 179, that is the 61.8% retracement. And also we might trade in this range. Right now we're basically right at the 88% retracement level. We're a little bit, as you can see, sorry, I'll scroll down a little bit. We're just above that level. Wouldn't be surprised if we trade in this range for a little bit. So hang in there. But just giving you a real perspective there. Keep an open mind. Don't lose your mind if we trade down 2 to 3% and we go back higher. Normal movement, it just happens. This is a comparison between the Nasdaq and the TLT, which is the 20-year bond plus portfolio. This is the 10.5-year scope. Obviously a very good period. That's full disclosure. You're seeing during this period, Nasdaq absolutely killed the TLT. Perspective and time frame is everything. If I give you a 1-year perspective, what happens? You're going to see quickly. Diversification is important. TLT, the 20-year bond area, it did fantastic. I mean, this is on the year. This is a year performance. 24.15 versus the Nasdaq of 1.15. But does that mean the Nasdaq is done? No. In fact, I like to see periods of consolidation like this. It usually means it's building a base and probably going to go higher. Does that happen every time? No. But I am going to be overweight the Nasdaq and underweight TLT because it doesn't mean TLT can't go higher. For a conservative portfolio, nothing wrong with this. But it is a little bit overbought in my opinion. We've shown that in other videos. So keep that in mind. Something to keep in mind there. Let's see what happens if I go to... I think it's 16 is the farthest I can go because the TLT, I do not believe expanded was even created that long. So this is a 16-year time frame. Gives you a more fair comparison over 16 years. Nasdaq versus the TLT. Moving on. Put call ratio. In short, this is kind of show you the VIX and the put call ratio. Put call ratio, once we hit 98 on Wednesday, that was kind of a, man, this has got to be close to another bottom. But the one thing that did concern me, full disclosure, is we did not even get past the August 5th level in the fear index. Again, this was the date where the 10 and 2 inversion occurred. We did not even go past that, which makes me a little bit leery in the midterm. Could we go a little bit lower because all the fear did not get out? I think honestly, just a lot of advisors were out there and got ahead of this saying we might invert, calm down, stick the course, and don't do anything stupid. It could be. Who knows? But long story short, look what happened December 24th when these things peaked. Boom, moved. Boom. Hopefully Friday was a nice day, and actually Thursday for the S&P 500 was a positive day as well. So who knows? But just giving you a different perspective to show you all different sides of this. Sorry, wrong chart. This is an interesting one. Pay attention to this. This will be high level, intro level, but it gives you details on the left to kind of help you. This is a beta perspective. Low beta is actually outperforming high beta. Low beta means less risk than the market. A beta of 1 is basically market performance or the S&P 500. A beta greater than 1 is more volatility than a market, usually has upside potential, more upside potential, yet has larger swings. Kind of interesting to see since the inception of these funds at Invesco, which was as of May 2011, that the low volatility index is killing the high beta area. In short, it's kind of living proof that if you're in large cap, good growth companies, historically has proven to do quite well. Really, REITs and large cap US companies have been throughout history the best areas to be. The S&P 500, you can see the black line keeping up pace with the low volatility. So again, this kind of also shows you multiple things. Be diversified, number one. Number two, S&P 500 is hard to beat, but it can be done. And that's why we are in existence. We don't believe a portfolio of 500 is necessary. Not all 500 companies do we believe are going to do well. And that's usually where we outperform, especially long term. So hang in there. Let's move on to the next chart. That's all for that. But let's move into the kind of the long-term bull case. Chandler Chrisman of Lexington, Ohio, a good friend, kind of mentored me along the way. Thank you so much for your help along the way, by the way. Great guy. Very knowledgeable. Sent me this. This is an extreme bull case. He's very realistic of that. Just kind of a longer term perspective that we all got to keep in mind. This shows a divergence, meaning the S&P 500 went up here and we had a divergence. This is like 2014, 2015. Same thing is kind of occurring now. Divergence. We went down in the RSI levels. A divergence means the market goes up and the RSI goes down. Usually we consolidate for a little bit, which is kind of what's happening here. And we go higher. The actual language from Ian McMillan is basically saying, look, we'll probably test. Hopefully we go above this retracement level. Again, it's a little bit high. I wouldn't expect this immediately, but we are testing key level area. Could we go an additional 30% above all-time highs that we saw last month? Again, most analysts that are technicalists, short term, it's going to be a grind. Long term, it actually looks pretty good. Fundamentals look okay. Hopefully the Fed remains on our side. That kind of concludes our message for the day. Kind of fact of the day that we want to reiterate is, one second, sorry. Housing equates to 33% of spending. Transports, 16% of spending, which accounts for almost half of all spending. I honestly, through what I see, would not be surprised if we actually have more monies allocated to the housing area. It's kind of the American dream to have this fantastic house, keep up with the Joneses scenario. Another interesting fact is, keep in mind only 40% of people even have a budget. It is not uncommon for me to see 70% of people's money's going to their houses. It's messed up. You don't need to be that person. Please don't be that person for your own sake. Biggest increases in spending over the past couple years have been college, not a surprise, and entertainment. Consumer is actually still strong. We've seen this. That concludes our message for today. Thanks for paying attention to us. Again, we want to get ahead of the concerns that could happen this week and the next couple weeks for that matter. So hang in there. Follow us on YouTube. You'll be able to pay attention to what we're doing, what we're thinking. And thanks again for your support along the way. Have a great rest of the day and keep an open mind.